Hey everybody, Rob Maurer here, and today we are primarily talking about how Tesla has recently been completely taking over the total valuation of the US automotive market. One of the themes we have been discussing over the last couple of weeks is how all this stress on the macro environment actually improves Tesla's competitive position. The thought process here is that the financial challenge that this probable recession places on other automakers will cause them to reduce any investment that doesn't have a super quick return on investment. And unfortunately, electric vehicle development falls into that category. The other point that I would make on that is that every single day that goes by, Tesla is iterating and improving on their product, making it more compelling to the market. And as the leader in electric vehicles, Tesla is the benchmark for any of these projects from other automakers. As Tesla advances and as that benchmark becomes more and more difficult to meet, it becomes more and more difficult to show positive return on investment in the forecasts for projects in the electric vehicle space. Think about the Model 3 and the Model Y, for example. If you are building a competing electric vehicle and it's going to be a normal sedan and you want to do any sort of significant volume, let's say in the six-figure range, you're going to need to have a vehicle that is competitive with the Model 3. If it's not close, you're not going to get to that volume and you're not going to be able to actually even build a forecast that shows a positive return on investment. And if you can't build that forecast, well, you're not going to do that project. So Tesla already made it hard enough with the Model 3, and then we introduced the Model Y, and now, okay, well, we had already sacrificed the sedan business. Tesla can take that. Now the Model Y is here. You have to build a vehicle that can compete with that. Otherwise, you're not going to be able to do volume in that category either. Your only hope is to rely on your brand or on some sort of differentiation from a category perspective. But again, day by day, Tesla continues to make that more and more difficult. This was obviously already proving challenging enough for other automakers. And then you throw coronavirus and a possible recession, a likely recession on top of it. That's certainly not going to help the progress for other automakers, but for Tesla, that's their core business. That's what they are going to be advancing regardless of what's happening. So their competitive advantage, their lead in this new paradigm of electric vehicles, only accelerates. Now, valuations change for a lot of different reasons, but the valuation changes of US automakers over the last couple of months have strongly reflected that competitive advantage. And credit to the market for starting to understand that drumbeat that many of us have been playing for years now. Again, a lot of factors here, but nice to start to see some of this being reflected. And I see this as a total validation of the fundamental repricing theory that we had discussed back when the stock originally rose to this new all-time high range in January and February. If we rewind a bit and we look at the US automaker market caps last year, Tesla was about 26% of the total at that time, with around a $45 billion valuation. Still the second most valuable automaker in the United States, second to GM, and then Ford and Fiat Chrysler coming in a little bit behind, but everyone sort of in that same range of 20 to 30% of the total market valuation. Then you fast forward to this year, and we go back a couple months before the coronavirus outbreak really started to punish the overall markets. And at that point, Tesla, sort of in the middle of its giant run, Tesla had actually doubled its percent to total from 26% last year in April to 52% to begin February this year. So representative of more than half of the total valuation of US automakers at that point. That continued into March, Tesla growing to 58% of total. Then the coronavirus impact really played out. We saw the dip, we saw the recovery, and now Tesla on April 17th sits at 67% of the total valuation of US automakers, representing a majority and bearing a strong resemblance to Pac-Man eating the other automakers. Last year at this time, GM represented 33% of the total. Now, GM, Ford, and Fiat Chrysler represent 33% of the total, with GM at 15%, Ford at 10%, and Fiat Chrysler at 8%. In fact, over the last month coming off its low on March 18th, Tesla has added $72 billion in market cap alone in 1 month. That's more than the entire valuation of GM, Ford, and Fiat Chrysler combined today. Think about that, 1 month. It's pretty incredible. It wasn't all that long ago that Tesla's market cap was in that $30 billion range, and now it's moved 2 times that in a single month. Now, when we talk about all this, of course, critics are going to argue that we shouldn't just be looking at valuation. It's not representative of what's really playing out. It's just perception-based. Although that is kind of the point of investing, right? We're talking about valuation. But critics would say we should be looking at vehicle sales or profit or revenue. And of course, the pie charts for those would look much different. Sure, that's fair. If you look at any of those metrics, though, they're all heading in this direction. Tesla's growing, the others are declining. Tesla's increasing their share of that pie chart. And also, none of those metrics are forward-looking. And basing a valuation argument around historical numbers is complete folly. You hear it all the time in disclaimers for mutual funds. Past performance is no guarantee of future results, and that definitely applies to fundamentals of the business as well. I think the more surprising part is actually seeing the market realize this. The other consideration, and this argument will probably come from the bullish side, is that Tesla should be valued as more than an automaker, so why are we even comparing them to Ford, GM, Fiat Chrysler in the first place? Sure, that's at play here. Tesla has autonomy, energy, insurance, charging, go on down the list. Those are all important elements of Tesla's business, though they are secondary factors on Tesla's valuation. But that doesn't invalidate the comparison of Tesla's primary business of automotive manufacturing at this point, because at the end of the day, these are the companies that Tesla is going after, and these are the companies that Tesla is going to kill first. Let's take a quick look at Ford, for example, because they've been in the news quite a bit this week. On Monday, they issued a profit warning, which is something a company does when their results are not going to meet analyst expectations by a pretty significant margin. So Ford shared a few preliminary details, saying that their wholesale vehicle sales, so vehicle sales to their dealership, which is how they report, were down 21% from Q1 2019. Their revenue was about $34 billion, so down 16% from last year. And they expect their adjusted earnings before interest and taxes to be a $600 million loss versus a $2.4 billion gain last year. These results come to us after Ford already announced in March that they would be raising additional cash from their credit lines, drawing from two other credit lines, suspending their regular quarterly dividend, which is $600 million per quarter, and withdrawing all 2020 financial guidance, which we know Tesla has yet to do, though that remains to be seen if something changes on the Q1 earnings call. Beyond that, and perhaps most relevant to today's conversation, was something that Ford reiterated in this profit warning that their CFO, Tim Stone, had said last month. They say, quote, Stone said the company is taking other steps to preserve cash, including by lowering operating costs, reducing capital expenditures, and deferring portions of executive salaries, end quote. Heavy emphasis there by me on reducing capital expenditures. That's what we're talking about here. When these financial hardships arise, companies look for areas that they can cut, and CapEx is one of those areas. Some of that CapEx is going to be mandatory. The stuff that's not mandatory is going to be for future projects that can expand or grow your market, or perhaps keep you relevant in the new paradigm. But of course, management with a short time horizon and investors that are seeking value and dividends rather than growth are going to say, yeah, go ahead and slash that CapEx because that's just going to come right back in depreciation and amortization, and that's going to lower the returns that we're generating today. The degradation in Ford's business position can be easily seen in the interest rates they've been able to attain on debt, and this is in just the last couple of months. First off, heading into the year, Ford's debt rating was already in the junk category. Their rating was further downgraded by Moody's in late March. Before that downgrade, Ford in February had issued 5-year bonds at a 3.5% interest rate. Today, we have news from Ford that they have issued more bonds, a portion of which are a 5-year term as well. And those 5-year bonds are at a 9% interest rate now. So 3.5% interest rate 2 months ago, up to 9% that Ford has to pay on that debt today. That hurts. I mean, if you've ever paid any interest on anything, think about paying 2.5 times as much interest on that. Whether it's student loans, interest on your mortgage, interest on credit cards, you're not going to want to pay 2.5 times the payment for interest. And that's what Ford is having to face here with this new debt. So this issuance for Ford was $8 billion. That will carry those high interest rates. And back to the main subject here, when you are carrying a lot of debt and you have high interest rates on those debts, you're going to be trying to focus on paying that off. You're not going to be investing in electric vehicles. Look, the point here is not to just pick on Ford. Business is tough right now. Business is tough for everybody. There are difficult choices that need to be made. My point here is to bring to light the position that Ford is in versus Tesla and how those positions are heightened because of the pressure in the macro environment. And this isn't just Ford, this isn't just US automakers, this is across the board all legacy automakers versus Tesla. Volkswagen just yesterday issued a similar profit warning to Ford, saying that their sales would be down for the first quarter about 9%, and that they no longer could achieve their 2020 guidance. And again, most relevant to today's conversation, adding in their profit warning, quote, securing liquidity has the highest priority, and optimizing working capital and prioritizing investments are key focus areas, end quote. So again, my emphasis on prioritizing investments. Now that prioritization probably looks a little bit different for Volkswagen than it does for a company like Ford, but all the automakers are going to have to go through a similar prioritization of investment process, and things will be cut or at least delayed. Tesla may face some of that too, but as we saw with Q1 sales being up 40%, the fundamentals of Tesla's business are not going to be in the position that the legacy automakers are going to be in this year. And unlike almost every other automaker, Tesla doesn't have to make the decision whether to invest in ICE vehicles or electric vehicles. There's only one path there for Tesla. How could their lead not increase under those circumstances? All right, 3 quick notes here to end the day before we close it out. The first is that a local ABC station by Gigafactory Nevada is reporting that Gigafactory Nevada is scheduled to reopen on May 4th. This should not be surprising. Tesla said in a previous announcement that all their US production would reopen on May 4th, so we had already been speculating that that was the case. But we do have some reaffirmation of that idea here, at least for the moment. Second quick thing is that there are reports from China. I believe Tesla Mania on Twitter did this, but I don't have it in front of me. That Tesla is offering 3-year 0% financing on the full self-driving option when that is selected with vehicle purchase. Thought that was a little interesting, so wanted to pass it along. And then lastly, the Hornsdale battery pack project. We talked about a while ago how that has been expanding. That expansion has now been completed. So this is now a 150 megawatt, 193 megawatt hour energy storage system. So that'll wrap it up for me for the day and for the weekend. Don't forget to subscribe and sign up for notifications. You can also find me on Twitter at Tesla Podcast. And if you want to support the podcast, you can find more details about doing that at patreon.com/Tesla Daily Podcast. That's it. I'll see you on Monday for the 420 episode of Tesla Daily. Thanks.